So in this video I'm going to be going over the crypto debrief regarding the FTX situation and how the FTX collapse has affected certain particular data points when looking at the crypto market. Firstly, we're going to look at the Bitcoin market depth. So the market depth refers to the amount of resting orders, those are your limit orders, sitting within the 2% range of Bitcoin. So for example, if Bitcoin's at $20,000, we're looking at the amount of orders from $18,000 to $22,000. A deeper market means that there's more orders in that range, meaning there will be a less volatile market and an easier market to get filled in at. So you can see how after the CoinDesk investigation, how we have a big drop from 12,000 BTC down to around 6,000 BTC. So the 2% market depth actually drops around 50% after that situation. And that comes to the market makers removing their orders because of the uncertainty of the situation. So that results in an increase of volatility, and you can see how now it's began to recover. So we've gone from just above 6k back to just below 10k. So we're still not at the levels that was previously seen, but it's on its way up. So regarding the specific recovery, we can see how really it's Binance who's had the greatest recovery from that period. So they've gone from around 1.5 thousand BTC to just under 3,000 BTC from around November 14th to November 21st. And again, that's because they're the largest leaders of volume and etc. So they need the most depth in order for their market to continue operating as it is. The others have really, the others didn't take as much of a hit. You can see Binance US did take some, but they're roughly around the levels where they were pre-collapse, and that's because they don't really do that much volume. Binance is really like 70%, 80% the leader of this crypto market. So now looking at the BTC spreads. So the spread is essentially the difference between the nearest buy and sell price. So if I'm to buy BTC at $20,000 and instantly try to market sell it, I need someone to be limit buying it, and that is going to be my spread. So if I'm buying at $20,000 and the next closest sell order is at $20,005, that's going to be a 5 BPS spread. So again, a lot of these orders are going to be limit orders from market makers who are going to be trying to make the market more liquid. And after the FTX collapse, a lot of these market makers are actually going to be removing their limits off the exchanges. You can see here how the spread increases after the FTX collapse and goes back to its normal levels afterwards. However, on Gemini, you can see how the spread actually stays high, suggesting that market makers didn't actually get back onto those exchanges. How Gemini BTC spread stayed really high, that's because the interest-bearing earn program was impacted by Genesis halting withdrawals, and the uncertainty surrounding Gemini at that point meant that market makers didn't want to get back onto exchanges to reduce that spread. Now looking more at the DeFi scene, we can see how the heaviest impact was actually hit by L1s in this situation. Regarding Sol and FTX, we know how closely they're linked with each other. So Sol kind of brought down the L1 market the most. So you can see it's down 33% as of the 22nd of November. Whereas the DEXs, the DeFi exchanges, and Bitcoin had a much lesser impact, almost half of that. Interesting point is also that the DYDX token is up 18%, showing that people are starting to realize the importance of self-custody, and DYDX is an exchange where you can connect it directly with your ledger, so money actually never needs to leave your cold storage. Now regarding the weekly volumes, we look here and we can see how we have Binance in blue and the 10 other largest exchanges by volume combined in orange, and how the Terra collapse and the FTX collapse actually had a very similar effect on the volumes. So volumes have actually dropped 50% just on Binance alone after the FTX collapse. Again, just the fear of the situation, people moving money off exchanges, people being scared to trade. And looking here at weekly trade volumes, we can see how much volumes decreased on specific exchanges. So you can see how HuBoy was actually the largest percentage reduction, 80% reduction in trade volumes. Trading on some popular DEXs, for example Uniswap, we can see how volume actually increases. So the effect of centralized exchanges losing people's money pushes people towards decentralized exchanges. So Uniswap is an example, and we can see how we have a large spikes in volumes with two scenarios where we've had big crypto destruction to say. Regarding the Bitcoin perpetual futures market share, we can see how before FTX collapsed, it actually had around a 10% volume of the daily BTC perpetual futures. And now, as FTX slips away, we're gonna see who's gonna take over most of that volume. So we can see since the start of November, Binance is actually up about 7%, with their perpetual volumes rising from 56 to 63%. And Bybit has won about 3% of that volume left behind, while OKEx and Deribit didn't really gain anything in that period. So showing that most traders are actually moving their futures accounts to Binance and to Bybit. So we're looking at a data point I like to use, and that's the funding rate. So the funding rate is a good measure of market sentiment because it's essentially the difference between how many people are longing and how many people are shorting. And after the FTX situation, we had a situation where a lot of the exchanges were kind of under threat, because if FTX could go down, it's a bit of a situation where anyone could go down at this point. So crypto.com was a popular one that people were getting at, and you can see how after FTX collapse happened, how a lot of shorting of the token went on, anticipating the fact that crypto.com might actually go down as well. And after it didn't, you can see how the funding rate actually resets back to a neutral value of 0.0. Another effect that FTX collapse has had is that Cardano has actually announced that they're going to be releasing their own stablecoin, and it's going to be called USDA, and it's going to be the first fully fiat-backed regulatory compliant stablecoin in the Cardano ecosystem. Prior to February, GBTC benefited from strong institutional demand and traded at a double-digit premium to its net asset value, providing an interesting arbitrage opportunity for large institutional players. Approved share creators could borrow or buy BTC and sell GBTC shares at a premium after a lockup period of 6 months. But because the premium turned into a discount in February as the buying demand weakened, essentially means that a lot of these traders are now locked into these arbitrage trades, and they're not able to get out of it until the discount can get back to a premium or get back to 0%.